What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulice, and our company, the Pulice Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everyone? Welcome back to another episode of the CPA Zone. Today, we have a special guest with us. We have Paul Moore from Wellings Capital. Paul's the founder of Wellings Capital. It's a real estate private equity firm. He published a few books, and he's got some great background in commercial real estate, which we're going to talk about today. So, Paul, thank you for joining us. If you'd like to give the listeners a bit more background about yourself, that'd be great. Love to hear your background story.
Yeah. What an honor to be here, Ryan. Thank you. I started out with an engineering degree. That was my first big mistake. And went on and got an MBA, worked at Ford Motor Company, had my own company. I sold it at 33 years old. And I thought, I'm a full-time investor now. And I thought I was, like pretty cool guy. And I turned out I wasn't a full-time investor. I was a full-time speculator. And the problem is I didn't know the difference, Ryan. I made tons of mistakes and I lost a lot of money. And I made some money speculating as well. I eventually got into real estate investing where I fared a lot better, and I know how to speak. And I also I built some houses. I found out this really important life lesson that you shouldn't build a house if you don't know how to tighten your own doorknob. I'm just saying. And but I eventually had a podcast called How to Lose Money, and I hosted that for years. And we talked about speculating versus investing. We talked about market cycles. We talked about how failure, pain, and loss can sometimes lead to bitterness or sometimes make you the best version of yourself. And all of our 230 plus guests, were telling us why they're now the best version of themselves. It was great. But yeah, I've written 3 books on real estate investing. I'm working on a few more. And I like to call myself the boring investor because it's exactly what I wasn't 25 years ago when I started in this business.
Gotcha. Awesome. So boring investors, that would you say that's because early on you were in that speculation zone, and then as you progressed, you got into the more what you consider a real investor, and that's where it gets boring because it's safe?
Yeah, I was a high energy speculator, entrepreneur, and I thought I should get the same excitement out of investing that I got out of, being an entrepreneur. But I didn't know what Paul Samuelson had said. He's the first U.S. Economist to win the Nobel Prize, and he said, investing should be boring. It should be like watching paint dry or watching grass grow. He said, if you want excitement, take $800 and go to Las Vegas.
Yeah, very true.
Yeah.
Good deal. Well, I know you've done quite a bit in the commercial real estate space. That's always a space that it's fascinated me. I have not invested in commercial real estate. I've invested in large multifamily deals, so I guess in that sense, somewhat commercial, but not anything like industrial or like your standard office space or retail.
Yeah.
Now, what got you into that, and what would you tell someone that is maybe considering making the leap into the commercial world versus their residential, if that's what?
Yeah. So I flipped 50 or 60 houses. I flipped a couple dozen lots at Smith Mountain Lake here in the middle of Virginia. And I realized that, Warren Buffett said, if you don't learn to make money while you sleep, you'll have to work until you die. And every time I sold a property, I had to go start another one. And I wasn't making money while I slept. And I realized in commercial real estate, that a couple things were true. Number one, I could set it and not set it and forget it. But, there's a lot of strategies where you can invest in commercial real estate and not have to work at it. Those who have read Rich Dad, Poor Dad understand that's the quadrant where, you're making money from money. And that's easier to do, I think, in commercial real estate. Um, Another thing I love about it is you can force appreciation. So there's a value formula. In residential real estate, everybody knows that the value is based on comps, comparable properties. In commercial, there's a math formula, and that says value is the net operating income divided by the rate of return or the cap rate. And if you can increase net operating income, if you can improve the property, you can directly impact the appreciation, and therefore your long-term wealth growing could be built on math. And sometimes if you buy a property with significant intrinsic value that you can, you can extract from the property, you can create a lot of wealth that way.
Okay, awesome. Yeah, good deal. Is there like what would you say some of the best ways to find that intrinsic value? Like if you're going out looking for a new deal,
Yeah.
especially for someone that's new, there's gonna be a lot to learn, but how do they identify those deals when they're out there looking and try to find that intrinsic value?
I'm going to start with an example, and then I'm going to circle back and
Okay.
argue with myself if I can. Um, an example, I wrote a book called Storing Up Profits about self-storage. It was published by Bigger Pockets about 4 years ago. And self-storage and mobile home parks are great examples because self-storage, there are about 55,000 self-storage facilities, and about half are run by mom and pop operators. Mobile home parks, 44,000 or so, and about 60 to 80% are run by mom and pop operators. Mom and pops typically don't have the desire or the resources or the knowledge to improve the property, drive increased income, and maximize appreciation. And so they leave a lot of meat on the bone. Warren Buffett said, price is what you pay, value is what you get. And some self-storage facilities, I'll just give you a quick example. Let's say you bought a self-storage facility, and this is common actually, from a mom and pop owner. They say, hey, there's 6 acres out back. I don't really use that. Oh, thank you very much. That, it could be paved or it could be progressively gravelled to test it out. You could rent spaces for trucks. You could rent spaces for industrial equipment or construction supplies. Or you could put, boat and RV storage back there on that 6 acres. You could build, you could build out more, storage. You could build a climate control building, for example. You could rent the space by the road or build a billboard. You could possibly put a cell tower on that back 6 acres. You could possibly put a propane filling station or an ATM out front. You could set up a little showroom to help upsell clients, but also to sell locks, boxes, tape, and scissors. You could do a partnership with U-Haul, and you could add perhaps $2,000, $3,000, $4,000, $5,000 in net income a month. Now, remember our formula. If you add $3,000 a month in net income, that's $36,000 a year. 36,000 divided, remember the value is the net income divided by the cap rate. So 36,000 divided by, let's say, a 6% cap rate, 0.06, that will give you an additional $600,000 in value. Well, if you bought a facility for, $1 million and you add $600,000 in value just by signing a deal and setting up U-Haul in front, that's a pretty sweet deal. That could double your equity overnight. So there's lots of value add opportunities like that. Here's the problem. If you're a full-time professional, if you're a CPA or an IT professional or a doctor, dentist, lawyer, the question is, can you really find these great deals? Is it possible? Absolutely. Is it likely?
Yeah.
Not as much. You're competing against people who are full-time combing the streets looking for these deals.
Yeah.
So,
Professionals.
you got to ask yourself, is it better to jump in on the side, which you could do and eventually transition to full time like people do all the time? Or is it better just to invest passively with somebody else who is doing it for a living? And that's a question everybody has to ask themselves.
Yeah, and honestly, that's exactly what I did as I progressed. I started off in single family, owned some homes, and several years ago started transitioning out of those into multifamily, more recently assisted living. But I've been going the passive route entirely, 'cause I find other people that know how to find the deals and operate them, because my day job, I'm a CPA, so I focus on what I know how to do and let others kind of do what they're best at, work with the professionals and invest with them. And that's
Yeah.
worked out well for me so far. And honestly, that's what I see. A lot of people, they have a successful career. They want to invest in real estate. They might start out on their own, and then eventually they end up going the route where they're putting their money with professionals that can help them maximize their
Right.
returns. Yep.
Yeah, I mean, both are good options, but I tell you, I have 1,030 investors with us, and a huge percentage of them are professionals who tried this for a while and realized it wasn't as profitable as they thought to do it on the side. So now they give money to us and others like us to invest for them.
Yeah. Yeah. It wasn't another Warren Buffett saying was don't put your eggs in many different baskets. Put them all in one basket and really focus on that one basket. That
Yeah.
yeah, that's where you focus and spend your time is that's how you're
No,
going to get your
Buffett.
best results.
So, Ryan, I'm writing a book called Warren Buffett's Rules for Real Estate Investors. And I really got irritated with Buffett when he said that, because I thought, well, I mean, our company's focused on deep dive due diligence. We looked at 900 deals so far this year. We're about to invest in our fourth one out of 900. But we also provide diversification. I didn't like when he said that, but then I realized, wait a minute. Berkshire Hathaway has 28 employees in their headquarters, Fortune 7 company, and they're in 108 different businesses, 108 different lines, 108 different asset types, different management teams. What I realized is diversification for the investor is helpful, but each one of those lines of business, if you will, should be hyper focused on what they do best.
Yeah.
So Dairy Queen shouldn't go out and buy timberland to create pulpwood to build, to run through their paper company to make cardboard for their cartons. That's dumb diversification. Dairy Queen should be obsessively focused on what they do best.
Yeah. Yeah. No, that makes total sense. So what do you without I don't want to kind of put you on the spot and to like make any predictions, but what are your thoughts on the current commercial real estate market? These last few years, I think for real estate in general have been a uh, little bumpy. There's a lot going on. The interest rates sure haven't helped. They're coming down a little bit, but I just feel like everything in general has just seemed like I don't know. We're almost in like a little holding pattern on things. Just curious what your take is on things right now.
Yeah, at the risk of sound like a broken record, I'm going to quote Charlie Munger and Warren Buffett again. They said that in 60 years of investing together, they never had a conversation about the economy when deciding to make an investment or a divestment. And it's kind of hard to believe. I didn't believe them for a while, but then I realized they said they want three things in an investment. Number one, they want a durable product. Number two, run by a great management team. Number three, with significant intrinsic value. In other words, they're buying with value potential far exceeding what they pay. In real estate, that looks like a recession-resistant asset type, which I think's mobile home parks, self-storage, for example, run by a great management team, somebody who's obsessively focused and experienced on that asset type, and again, with intrinsic value. And like I said before, often that's bought from a mom and pop, but sometimes it's acquiring those from an institutional investor who took their eye off the ball. We've done two of those, and those can make sense too. That said, I wrote a book called The Perfect Investment in 2016 about multifamily investing. And Then I went on Bigger Pockets, which is a big real estate forum. And I said, I kind of yelled for like 3 years on there on my blog posts and my little show I had on Instagram and Facebook Live. I said, time out. The perfect investment is not perfect. If you have to overpay, over leverage, and believe that trees really do grow to the sky, in other words, that rents would continue to go up at 9% a year, I said, this is a house of cards that's going to come crashing down. And of course, the interest rate spikes. In 16 months, we had 11 interest rate hikes from 2022 for the next few years. And it really was the spark that lit what was already the house of cards waiting to fall. And of course, we've still seen the fallout from that now. We see extend and pretend going on. There's lenders, CMBS, and other lenders who just keep allowing a bad deal to keep going because they don't want to foreclose into a not the best market. But honestly, Ryan, I mean, I was talking about multifamily at the moment. The demand and supply is so out of whack in favor of apartment owners that the next decade is going to be very, very strong if we don't screw it up
Yeah.
again by using risky floating rate debt and overpaying.
Yeah. Yeah. That's it. It seems like they just can't make enough like workforce housing. So
Oh,
I
it's
think you're
so
right
true.
there.
I mean, it's going to be a terrible time to be a renter the next decade. I'm telling
Yeah.
you, that's my prediction. And I'd hate to be a renter. I really would.
Yeah. Yeah. And the price of homes, like to buy homes, just like more and more people seem to be getting priced out.
Yeah.
So they're going to be forced into the rental world. So yeah, no, that makes sense. I guess a little bit kind of shift gears a little bit because we do talk about tax and accounting on this podcast. I was wondering, just throughout your career, some of your favorite tax strategies to use in the commercial space.
Yeah, there's so many. So in
Yeah.
a couple different books I mentioned, I have a chapter on this. Um, let's think about where to start. So of course, they on July 4th, they just signed the big beautiful bill, and love them or hate them. Trump, a commercial real estate investor, brought a lot of benefits, and one is accelerated depreciation.
Yeah.
Of course, we already had accelerated depreciation through cost segregation studies. And for those who don't know what that is, that basically means you pull apart, you do a study to segregate the short-term elements and the long-term elements. So, maybe a foundation of a building, and I believe the walls would be permanent elements that would be depreciated over maybe 39, I believe it's 39 years with
Yeah.
commercial real estate. But then there's stuff like fixtures, furniture, lighting, windows, other things, roof that might be depreciated over 5, 10, 15 years. And this law, the big beautiful bill, allows that the acceleration of that and compression of the first, I think it's 18 years of depreciation into the first year. What this can cause or allow is a significant paper loss
Yeah.
for real estate investors. So, for example, in a mobile home park, let's say it's a $10 million park, and let's say the value of the land is, let's say, 2.5 million. So there's 7.5 million in infrastructure and other stuff. Well, a huge percentage of that, possibly 80, 90% of that 7.5 million can be accelerated into the first year under this
Yeah.
bill. So that means if, let's just say, $6 million out of that 10 million could be, a tax deductible, if you will, for a simple way of saying it, in the first year. Well, if there was 70% debt on that, that means there's only 3 million in equity. That 3 million in equity gets a $6 million tax deduction in year one. So 200% paper loss. Now that's an extreme example,
Yeah.
but there's other examples in multifamily, industrial, self-storage, student housing. that, also, I mean, I got one right now that already has the cost seg study done on it. We're getting ready to invest this week, and it's a 40% paper loss
Yeah, that's
from
awesome.
a student housing property. So that's a great example. Anything else you want to talk about on that one before I go on?
No, I think that's great. And I've heard before just the crazy write-offs you get from the mobile home parks, and it's all those land improvements that are 15-year property and eligible for bonus depreciation.
Right.
Just get yeah, that's awesome.
Yeah.
Now you can expense everything. It's assets with a life of 20 years or less. You can write off in the first year with this
Yeah.
100%
So it's
bonus
20 years or
depreciation.
less.
Yeah.
Okay, good.
Yeah. So but that's incredible. Yeah. I've heard before about mobile home parks.
Yeah.
Just, and I've seen it, just what a tremendous year one write-off you can get with those things. So
Yeah. RV parks are similar. And of course,
yeah.
I've heard gas stations are even better. So,
Yeah, it's the way gas stations have like a special classification under with the IRS. So almost everything is considered a land improvement, so they can write it all off in that first
right.
year.
Yeah. Another example is, of course, the 1031 exchange. We thought we were going to lose that in December 2017. They passed
Yep.
the first big tax bill under Trump. And then, of course, it was reaffirmed in this new bill. And the 1031 exchange allows people to effectively swap one property for another. And by doing that, they're kicking the can down the road on capital gains. Now, another aspect of that is swap till you drop, which means, I've got a 78-year-old investor with us who's in poor health, and he won't dare sell any of the properties he has because he has swapped from the 1970s or 80s forward several times. He's got massive capital gains built up in these. And when he passes away, up to a certain point, of course, all that capital gains will be effectively erased for his heirs, and they reset the basis to the current value. So that's another great one. Delaware statutory trust could potentially be part of that chain as well, by the way, and that's something we could talk about if we have more time.
Okay, yeah, yeah, and I'd be happy to talk a bit about the DSTs, the Delaware Statutory Trust. I've had a few clients go into those as well.
Yeah.
You know, from what I've seen, they tend to be more like higher, like grade A type investments, but they help facilitate an exchange, just like a 1031. But instead of you going out to buy or find a piece of real estate for yourself, you go into this DST and you get units or a percentage of the DST, and they find the investments for you, which similar to a syndication, but 1031 exchanging into a syndication is very difficult.
Yeah, one of my investors, the same guy, actually, the 78-year-old guy, he was so tired of managing these properties, that he swapped over and over. He's like, I'm too old for this. I want to play more tennis. And so he actually swapped into a Delaware statutory trust, which allowed him to maintain the 1031 exchange, but handed the management responsibilities over to somebody else. And I've got a special report I have for investors about how to think about DSTs. There's some big pros, but also some big cons.
Yeah. Yeah. I've had a few clients go into them, and similar to like the gentleman you're speaking of, they're kind of at the end of their investing career and just wanted to get out, but they didn't want to sell any property. So it's a pretty, it's a nice option to have in your exit strategy.
Right. Another one, which is kind of similar, is a 721 exchange.
Oh yeah. Yeah. Most of them tend to go with the upreads.
Yes. So one of my investors is named Candy. Candy had a self-storage property in Pueblo, Colorado, and she wanted to sell it, but she didn't want to pay the capital gains. She really liked the place she was selling it to, and so she just she swapped her property into his fund and got shares of the fund instead. And now she doesn't have to pay capital gains, at least for now, because she's swapped that in. So it's similar to a 1031 exchange. It's giving the management responsibility to the new buyer. It's similar to like if you owned Amsoil years ago and you would have sold it to Berkshire Hathaway, and Berkshire Hathaway just traded Berkshire stock instead of cash for their investment with you. So it's similar to that. Another one is just correctly classifying deductions. There's some capital gains, there's some capital improvements that could have been expensed in year one. And is it section 179 or what
Yeah,
is?
Section 179 is the like depreciation where you get to expense everything in year one, similar to bonus,
Yeah,
but you have to be an active business and it can't create a loss. But if you have an operating business,
yeah,
Section 179 it's great because you can take that, especially the last few years when we didn't have 100% bonus, you can use
right,
Section 179 to
right.
still get that full write-off.
Yeah. And then one people might not know about is a QREP, a qualified real estate professional.
Yeah.
Um, a lot of people who are professionals, high earning professionals, they can qualify for this even though they can't themselves. Their spouse goes out and gets maybe a real estate license. They start actively managing a couple Airbnbs or properties. And if they put in, I believe it's over 700 hours a year and
Yes,
it's
750.
750, and then if they do that activity more than any other,
Yep.
they can potentially qualify as a qualified real estate professional, which means
Yeah.
their paper losses, their depreciation, could be taken against active income. Isn't that right, Ryan?
Yeah, yeah, it is. That is probably one of our favorite strategies that we use that a lot, where one spouse is a real estate professional and the other spouse tends to have like a high W-2 job, or maybe they own a business where, they're not doing anything else, and you could take those real estate losses and start offsetting large chunks of their W-2 or business income.
Yeah,
And then you take those tax savings, just buy more properties. You kind of keep just cycling things forward.
yeah,
I've seen people just really accelerate their trajectory and their like investment plan by
yeah,
using that strategy. So they're taking all those tax savings and plowing it back into new
yeah.
properties every year.
Yeah, and I want to give one more tax strategy here, and it's not what some people would typically call a strategy. I had a friend named Bill 11 years ago, 11 or 12 years ago. Bill met with his CPA. He had been actively investing in commercial real estate for a decade or more, and he said he averaged 120,000 a year tax bill. But he discovered the accelerated depreciation. He discovered some other things like some other tax strategies on his own. And he met his CPA for lunch and he said, "Hey, did you hear about this?" And the CPA said, "Yeah, I know about that." He said, "Why didn't you ever tell me?" He said, "Okay, what else?" And he told him another strategy. He goes, "Yeah, that's a good idea. You should do that." And my friend Bill said, "Why didn't you ever tell me?" And he said, "Well, I just do your taxes. I'm not a tax strategist."
Yeah.
That was the last time he ever met for lunch with that CPA.
Yeah, I
He went out and
bet.
found a great CPA who strategically planned. And he said since then, he's never paid a dime in federal tax in the last 10 or 11 years. And my point to your audience is this: you're at the right place. You're listening to Ryan on this podcast. You're strategically, people like Ryan can strategically help you avoid taxes. And, by paying less taxes, which is potentially the biggest detriment to you building wealth, you're going to be able to build a lot more wealth. So, Ryan, thank you for doing what you do.
Oh yeah, well, thank you. I appreciate it. That's very kind. We are coming up about on time. Did you want to touch on any other tax strategies before we wrap up, or we
Um,
kind of covered a lot there, but that's great.
Yeah, I
So,
think
I love
I think
talking.
those are some of the main ones. The other one most people know already, and that is do all you can within a self-directed IRA and especially a Roth IRA.
Yeah.
I think a Roth IRA was one of Congress's biggest faux pas. I can't believe they allowed that. And of course, it's to all of our benefit that they did.
Yeah. Yep. 100% agree. Well, I really appreciate you coming on. We'll have to do it again sometime. Everyone, thank you for tuning in. Appreciate Paul joining us. Until next time, I hope everyone has a great day. Thanks a lot.
All right, thanks.
Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's ThePulicegroup.com/contact.